Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi everyone, how you going? Welcome to the podcast. It's one of the highlights of my week is recording this, particularly in this market we're in right now. I think back to a year ago, and it was probably, and I'll ask the team to check it out. The first time I actually used the word COVID-19 or coronavirus on this podcast. It'll be interesting to have a sort of look back and think about 1 year on now, and imagine it was around this time in 2020 that I first used that word, just my initial thoughts or perceptions around it. And one of the great things about the Smart Property Investment Show, if you're new to this or for those of you who are pretty engaged, it really allows us to diarise property in Australia in a very authentic and organic way, chatting to those people on the front line, whether they're professionals that work within property or those people investing in property in a real emotive sort of way. So we'll start doing some look backs, think back. I'm looking at our producer right now, Todd. There's something we can do pretty well. He's nodding, just to relive some of those stories and maybe have a rethink about how we saw it then and how we see it now. And the benefit of hindsight is a powerful thing. But if I think about how we have navigated at Smart Property Investment COVID-19, I think we've been pretty true to the roots in that. We've stayed the course. We haven't deviated from property as an asset class, despite some of the information that has come through, particularly at a point in time when banks were talking down property by up to 30%. So we'll do that. That'll be a bit of fun. We can see what I thought. Maybe everyone will think I'm an idiot from what I thought way back then, and no doubt that's probably some truth in that. But this is what I would like to do. So thanks for joining us as we navigate property. We get a lot of really good feedback on the show that I get a real kick out of, so does the team. So if you want to share some of that, make sure you get in touch with us. You can leave a comment wherever you're listening to this right now, direct messages through any of the social stuff, Smart Property HQ, or send a note to us, editor at smartpropertyinvestment.com.au. Always keen to work out what we can do better. We're in your hands. Constructive criticism is the only way that we can grow and evolve this, so let us know what's going on. But we do get a lot of feedback on the Smart Property Investment Show. Get a lot of questions coming in, and I've made it a commitment to try and do more of the question and answer type podcast episodes to answer those questions direct. And we've actually got there's a real cool tool on the smartpropertyinvestment.com.au website where you listen to the podcast. So you can click into any of the podcasts online there on the website. You can click on a button that says record your question, and you can leave a question. We'll get that answered live on air. So we've got one of them today. We'll do that a little bit later, but it's a Q&A session, which means it's just not me. I actually bring someone to the studio that typically knows what they're talking about today. It's a bit of a partner in crime of mine. He co-hosts, or he's the talent on the podcast Inside Commercial Property that we do. Scott O'Neill, Director of Rethink Investing. He's the brains today. He's going to go through some of these questions we've got. Scott, how you going? Good?
Yeah, pretty good, mate. Yeah. Thanks for getting me back in here.
Now, it's good to have you here, and I'm really enjoying the Inside Commercial Property podcast. And if you haven't listened to that yet, go and check it out. If you've got a particular bent towards commercial, or you're thinking about expanding or diversifying your portfolio into commercial, we go through absolutely everything in relation to it. And we're not talking about big office blocks. We're talking about the sort of stuff most investors are buying. So go and check it out. We cover all asset classes, whether it's industrial or office or retail or specialty type stuff. How to do it, why to do it, when to do it, what to look out for, how to get it right, how to miss getting the stuff wrong. So we do that every single month inside Commercial Property. Go and check it out. It's on the Smart Property Investment Podcast Network. But Scott's here to answer some questions today. Before we get there, Scott, how's the world treating you, mate? Are you're running ragged like most buyers agents and property strategists I know right now, trying to keep up with what is probably the maddest market most people have seen in maybe a couple of decades?
Yeah, look, exactly the same as everyone else. It is long hours, like on the emails at 10 o'clock every night at the moment, just keeping up. It's really just keeping up. I'm not trying to chase new business or anything. There's just so much demand, and it's like I've never seen anything like it. And it started pretty much from November. So it's carried through December, and obviously the first few months this year. And it's really the problem with the market is there's no stock out there. So there's more buyers than ever, and there's less properties to choose from than ever. So that combination is just making prices go up, and we can see it on the coalface. It is happening. We're losing properties by 5% extra, by someone else with a cash offer. And this is happening in both residential and commercial. And it doesn't look like it's slowing up anytime soon.
So I get the privilege to ask the first question then, and I guess as an extension of that first one, considering the picture you just painted then, and I've used a buyer's agent for all of my purchases, a huge advocate of buyer's agents. I think they're really good, really useful in markets where the equilibrium is the other way around, where there's heaps of properties and not a lot of buyers. And, typically a lot of people think buyer's agents will get you the best price possible, get you a lot cheaper, they'll get you properties that no one else gets, etc. To flip that on its head in this market, is there less relevance for a buyer's agent in a hot market because every man and his dog's out there buying properties are going up in value. So a buyer's agent isn't necessarily going to get you a red hot deal in this market. So where is the relevance and where is the skill set of a buyer's agent in a hot market?
Yeah, look, I actually think it's a lot more valuable. Like, I'll use our example. So we specialize in commercial investing and we do residential as well. But we've got the biggest networks in the buyer's agent space when it comes to commercial because we purchase approximately 25 to 30 million a month in property. And what that does is it gets the networks that allow us to get more off-market stock. So right now, if I'll use an example, like a Brisbane industrial property or a Sydney or Melbourne or even Perth or Adelaide or ACT, everyone is buying that stuff so quickly. But there's only a handful to choose from. So we're losing out to cash offers if it's online by a lot. So imagine the power of having one off market where we're the only ones looking at it. All of a sudden, we're saving a huge amount of money for the client because we're not having to compete with the market and it's more selection. So in a low stock environment, more selection is probably more important than anything because, it's about the quality of deal and we're getting a free kick for the market. You buy it, it's going to grow from day one. That's great, but you've got to get in the market. And if you don't have a buyer's agent, again, let's use another type market, the eastern suburbs of Sydney. There is literally 100 people going to every open home to buy a house. Imagine having one off market where it's just you looking at it. That's a pretty big privilege. And that's what a good buyer's agent who's established and been in the market for many years brings you. Now, there's obviously the old argument, not all buyer's agents have the same network. So it's important to have that kind of network and experience behind you.
Yeah, and I'm fortunate in that I probably unique in my role is that I'm connecting with most property buyers, buyer's agents, property strategists in Australia. And because I don't compete with them, I have no bias, right? So I'm sort of like a nice, safe Switzerland of buyer's agents in some way. And which means I chat to all of them. And the way I frame it, and I sort of get this question from investors as well going, well, I don't need a buyer's agent at the moment because I'll just go out and buy it myself. I think the buyer's agents, and talking resi at the moment, in this market are worth their weight in gold because a lot of them will stop you overpaying for stuff. It's good to have someone sitting on your shoulder saying, no, don't do that, don't do that, don't do that, don't do that, don't wait. That sort of counsel is really important now. Now, we've sort of been speaking on the Smart Property Investment Show for quite some time. A lot of people have fluke capital growth in this market purely because every market's red hot. And I had a chat with Andrew Wilson the other day, who is a well-known property economist. So he's pretty much saying the same thing. Just if you're in the market, you're going to do well, but some people are going to do better than others. And I think the people who are going to do better than others are probably those with good strategists on their side supporting them. In many ways, that's a buyer's agent. So we'll sort of keep this narrative going. I'd like to think that Smart Property Investment has been a vehicle for supporting and promoting buyer's agents in Australia over the last sort of 5 to 10 years. And it's something we're very proud of doing. So if you're not that yet familiar about how buyer's agents can help you out, you go to smartpropertyinvestment.com.au. There's a shit ton of information, a part of the French around it. And there's some really good operators in the market as well. So reach out, speak to a couple of them, see what they're going. They're all sort of operate a little bit differently and you'll find a match for you. So go and do that. Now, touch on a point that Scott made and essentially connected in with our first question, like 100 people going to every single open home. There's a question here from Sid P. I like maybe it's Sydney, but Sid P. Sydney was my grandfather's name. It's a cool name. He writes, I've been to 10 auctions over the last 4 weeks. I've lost each one of them. It's absolute madness. Why is every agent underquoting? And how do I get an advantage at the moment? Should I just give up and wait for the market to change so I can actually get a property, or should I persevere? We're seeing this all the time. It was only over the weekend, by memory, as an example, there's something in Crow's Nest which made the headlines. Crow's Nest is just sort of north of Sydney in New South Wales. Quoted at sort of 2.1, went for $3 million. So that's 900 grand over. It's nearly 30% over the thing. So there would have been a lot of disappointed punters at the auction there. So this is what you guys do for a living. Where there's commercial, you don't do a lot of commercial auctions. This is mainly resi auctions, but how do you compete at auction in a hot market? Or do you, as Sid's saying, just give up?
Look, you don't give up. You keep looking, but I think you've got to understand that there is probably a 10% fluctuation on the, that old asking price they put in day one. Because, look, it is a tool to lure people in, and the more people at the auction, there's someone that'll get a little bit more romantic over the property and try to throw the kitchen sink at it. And that's what happens. And right now, when the economy, for property at least, is looking strong with the low interest rate environment and just the outlook in general for property is good, there's less reason for people to hold back. So it's going to keep happening. My advice to clients in that situation is you just don't get disheartened. We're at probably a low point in terms of the stock levels. Like, it probably won't get too much worse than it currently is. And there will be a point where people start looking to realise their profits as well.
That's what Andrew Wilson said the other day in the podcast.
There you go.
That more people are going to come on.
Yeah, because it's tempting. Like, I know, where I live in Sydney, I'm getting letterbox drops for people to buy the place for a lot more than I paid for, and I wouldn't sell, but it's tempting if it got to a certain number. And as the market grows, let's say Sydney grows another 20%, there'll be a lot of people take profit. It's just like the share market. It doesn't just keep going forever. There will be a point where people have a reset and go, all right, well, I'm going to test the market because it's super hot. And, maybe there's downsizers thinking that there's a big baby boomer population in Sydney that own houses they don't use every bedroom. So maybe there will be a shift to downsize, and that will open up, hopefully, properties for younger families. So it's not forever. You don't need to buy it this month or next month or even in the next 6 months. The property market will go and swing in roundabouts forever. Just be ready when the right property comes up.
Yeah, I agree with that. And my message or counsel to Sid, and it wouldn't be advice, and just on that note, as a disclaimer, there's no advice at all in this particular discussion, just a couple of guys having a chat about it. Make sure you seek advice from whichever relevant advisor you use to make buying investment decisions. So this is just general chit chat, but counsel for Sid would be, mate, welcome to property investing. You've arrived. And if you, as a property investor, and this is for first-time investors, if you're successful in securing a property at auction, the first auction you ever go to, guess what? You've overpaid for it, I reckon. You've got to start getting a bit of scar tissue, and that is spending your weekends going to auctions, losing numerous times, not being the successful winner, because then you can actually start getting a read for how you play that game, how you actually effectively bid at auction, the psychology of auctions, the psychology of auctioneers, the theatre of auctions. A lot of people get carried away at auctions and end up overpaying. So there's a huge discipline to buying property at auction. And just on that note, Scott, what would be the top 3 things if you're going to look to buy at auction? What do you got to get right?
Well, first time, like my first property in Sydney, I lost 9 auctions in a row, and I was spending money on building and pest reports, and it was getting pretty frustrating. But I guess the one I won, it was funny because I didn't get a building report on that one, and there was turned out to be building issues. So lesson learnt, always get your building report. And top tips, everyone's got their own style. I like bidding strong and quick at an offer. So let's say someone's bidding, I'd immediately take it back from them. Let them have the front auction for 10 seconds, not even that. And I have seen it because I've won, probably 100 auctions over the years, and it does dishearten other buyers if you take it away from them very quickly. That's just what works for me. Some people rather sit back in the crowd and wait till the very last minute. That is probably the most frustrating thing for me, because you think you've got it and then bang, the quiet guy down the back's just blown you out of the water. And that is a very frustrating one to go against. But know your budget, don't go over it. If you go over it, maybe have like a 10 grand extra that you'll chuck in just for the sake of it, but you really got to have your budgets. And there will be another auction. I know it's frustrating, especially in a low stock environment, because you cannot see the house you want to buy for long periods of time, but it's a long life. Hopefully you don't need to buy it this year. There'll be a time when the market will come backwards as well. Like, for the last 3 years in Sydney, it's been pretty quiet. If you were buying in the middle of COVID when everyone was saying that market's going to crash 30%, you would have been laughing. So right now we're at the other end of the spectrum. So, it's the old Warren Buffett saying, be fearful when others are greedy and greedy when others are fearful. And everyone's greedy right now. So if you listen to Warren Buffett, maybe hold back a little bit.
Well, he seems to know what he's talking about. Warren at Berkshire Hathaway, one of the world's most successful investors. But to that point, let's use a bit of Buffett as part of this. You've got to do your time. He's been at it for years and years and years. He has a lot of scar tissue. He has a lot of experience. So don't rush out and try and think you're going to win at auction the first time you rock up, particularly in the market that we're in right now. But all right, that's good. Stay the course. Don't be disheartened. There's a whole bunch of auction strategies on smartpropertyinvestment.com.au. Go and check it out. We're going to take a quick break. When we get back, more question and answers. Back in a moment.
Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investors Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. Q&A session with Scott O'Neill, Director, Rethink Investing, also my co-host of the Inside Commercial Property podcast. Go and check it out wherever you listen to any podcasts. All good. Used to be at All Good Bookstores. Now it's All Good Podcast channels. But we're going to go to a audio question. This is from Steve Happy Gilmore. Steve, thanks for your patience, mate. I know we've been waiting to answer this one for a little while. Todd, do you want to play it for us, mate?
Hi, Phil. My name is Steve from Geelong. I have 4 properties currently, looking to round out and complete my portfolio by 2025. My question is regarding the purpose of each property. I believe you should know the purpose of each purchase. Is it for yield, it's for capital growth, or it's for development later? My question is, does this often change depending on the market as you move forward? For example, I have a property on the Gold Coast. I think I will keep that forever as a yield property, but perhaps Gold Coast goes through a boom and suddenly you could sell it for a lot more. Where a property down in Geelong might be for a capital growth play, in 5 years' time it hasn't grown at all, so you may as well hang on to that for the yield. So that's my question. I know that each time you buy a property, it should be put in for a very clear purpose into that portfolio. How often does that change depending on market conditions as you move through the years? Thanks, guys. Love it.
Nice one. Thanks, Steve. And appreciate the feedback you've been giving as well around the Smart Property Investment Show. Happy that it is supporting you as you make more informed investment decisions. Now, that's a really important question around the purpose of the property, but I might take a step back from that before I sort of hand it over to Scott. The purpose part is really tactical. So this is what do you actually buy in order to get where you want to go. Now, this is all around goal setting. Now, if you think of property investing as a business, and if you want to be a successful property investor, you got to think like a business. Now, most businesses, when they start, good businesses, or at least in some capacity, will have a business plan. Now, a business plan would typically have a vision, and then the vision would be connected with a mission. That mission would be connected with a strategy, and then you would have tactics support that strategy. So the purpose of your actual asset selection is at that tactical level. So if you start at the top, what's your vision? Your vision is to create a happy retirement where you can do whatever you want. What's your mission then? Okay, mission is to acquire the right properties at the right time in order to support that vision. What is the strategy to do that? I want to identify under market value properties, or I want to identify development orientated properties that I can add value to. And then you get to the tactical asset selection part of stuff. So start thinking that way if you're not thinking like that right now. It is very outcomes orientated. So the biggest mistake I see most property investors make is that they start anything they do with property at that tactical level, flicking through data pages, trying to find a suburb somewhere which might have X% capital growth. You're starting at the wrong end. You got to start at the strategic end. You got to understand why you're doing it, when you're going to be doing it, how you're going to be doing it, and then it's about the what. And the what is around asset selection. What do you see the best investors doing in this regards, Scott?
Well, you sound like a buyer's agent, mate. You sure you're not? That's you took the words out of my mouth.
I frame most things in terms of how I would run a business.
Yep.
Yeah.
Yeah. And look, that's where most investors get it wrong. I literally have a conversation every day of the week with someone that's built a portfolio, relatively large too, and they've hit a gap, a problem. They can't get more lending. They don't have enough money to retire on, or they've got to sell off an underperforming asset, or there's too many touch points with the properties, lots of maintenance, and they're literally getting sick of it. There's all these problems, and that exactly what you said is the reason why they get into those situations. And you don't need to live through it and spend $3 million on properties to work that out if you plan well. So, it's good that Steve's thinking that, because if you don't buy a property with a plan and a purpose, then what are you buying it for? To make a quick 5% growth that year? That doesn't solve anything, really. It's just on paper profit, which you need to sell off or refinance get it out. And that's not obviously ideal either. So first step is think about the types of properties you want to hold into retirement. So I had this conversation with a client because everyone, and this is going to happen a lot, everyone's running hot with the residential market because they think it's going to explode. And it may only grow 10%. And then what? You've got a property that is fairly low yielding. Maybe it's not in the best area for you, and the excitement will wear off very quickly. And I'm seeing this with potentially, this is just my little prediction. I'm thinking a lot of these regional areas that have shot up 20% in the last 12 months might have a recoil in 2 years' time once people realize their holiday home has $1 million debt on it, and it's not fun paying your land tax bill every year, and maybe you don't want to go to the same place every year for a holiday. Like, there will be a point when the economy changes and there is a lot of, I guess, potential for these markets to pull back a little bit. Because I was in Kiama last week and there's 2-bedroom units, a street back from the beach, going for $2 million. Like,
bonkers.
You can buy a really nice place on the lower North Shore, or a unit in eastern suburbs for that same money.
You can only look at the blowhole so many times, right?
Exactly.
There's a couple of good pubs there, but that's about, I'm not talking down Kiama, but some good surf spots just south of there. I'm not going to tell you where, but anyway.
But exactly right. Like, I just feel like there's not much strategy in some of these purchases that people run into when the market's hot. So my advice is look at the types of properties you want to hold long-term into retirement. And that's something my wife and I always did really carefully. Like, we bought the properties that are going to be held forever. And that's why we were kind of more geared towards cash flow, because if you don't have a good yield on your property, then how does it pay you a residual income that'll fund your retirement one day? And I've used the analogy of, if you buy $2 million of residential property and it's a 4.5% yield, after all your outgoings, even with no debt, you're probably going to clear about $60,000 in your pocket. That's not efficient for $2 million cash to only get that amount. And that's where, like, I obviously have done the switch many years ago to commercial, because you can get triple the income after all your costs. And the answer is you need a bit of both. So to answer Steve's question, yes, go into the markets where you think you'll get some good growth, but realize the growth will slow up at some point. And then are you happy with moderate to lower growth for a long period of time because the yield's high enough? So, it's not about selling off. It's very inefficient to do that in Australia. Flipping properties does not work if you look at the numbers as a percentage, because capital gains is terrible. You've got stamp duty implications. You've got sales agents. It just doesn't make too much sense. So, like creating a business, make sure the business has enough profit or income or rent, whatever you want to call it, coming through to support you into retirement. And if it's an efficient use of your money, then that's the type of asset you should choose.
Yeah. And, there's a lot of detail around purpose of property, and a lot of people, to Scott's point, one of the tactics you can use is pairing properties. So, if you're thinking about a long-term portfolio hold, you want to be identifying properties that have significant capital growth potential, right? But they aren't necessarily great yielding properties. So you might pair that with a high yielding property so you can get equilibrium out of your cash position. So you can get really, really tactical with it, but don't get caught up. It sounds as though, Steve, you're down the right pathway though. You've got the language of someone who would say is a bit more sophisticated investor. You've got a 2025 time horizon as you embark on this acquisition phase to build a portfolio that you're going to carry through to retirement. You didn't sound that old. I don't know what your family circumstances are or how many people you got working and all that sort of stuff. But to your point, 2025, when you reach 2025, and I challenge you this, you're probably going to change your strategy again, right? You're probably going to sit there and go, oh, you know what, maybe I've got capacity for a little bit more. Maybe I might shift up this, but no doubt your overall vision, the whole outcome that you want will be consistent. That should be, and I imagine is, entering a nice retirement where you've got plenty of cash to do whatever you want to do. And that's pretty much a guiding force for a lot of property. So it's okay to change how you get there in time, but you need to understand where you're going. And where you're going should be critical. And you've got to check in with that quite regularly. You can get caught up in the BS of property investment. And I'm personally in that phase right now. It's a headache. It's a nuisance. There's so much crap going wrong. I got to fix things all the time. I'm getting calls from property managers. This is just the rigor and rigmarole of being a property investor. But don't disconnect yourself too far around why you're doing it. You've got to have that beacon there. You've got to understand and rebalance and recalibrate every single time you get crap in your portfolio, why you're doing it. And that should help frame it. But it's okay to change. It's okay to change your tactics along the way, right? As long as you don't fundamentally change what you're trying to achieve. And you see a lot of people, you must see it, they go, I'm going to buy from land apartments today. And then you speak to them in a week's time, they're speaking to a taxi driver and they've gone, No, I'm not doing it. I'm buying house and land packages. You speak to them again another week, they go, no, I'm looking for renovators' delights. You get that a lot, right?
Yeah, and look, that's the hot spot seeker. It's a hot spot in Geelong. Let's get in. And I just think you buy for the long-term fundamentals. You don't chase the next little boom mining town or regional town because you think it's going to have a good 3 years. It's about a good 20 years. And that's how most successful investors invest, a 20-year horizon. And, that will iron out the sort of ups and downs of a market because over 20 years, if you've got 1% better growth over that long term, you've made a lot more money than chasing a quick buck in a boom town.
Yeah, and you got to say the course, and I was chatting with a mate of mine yesterday, we're having a bit of a laugh around the Sydney property market where both me and him have quite a lot of assets, right? We're having a laugh in that. Geez, we're really smart. Everyone is quickly trying to buy assets in this current market. Well, we bought heavily in Sydney, like a crap load back in like 2012, 2013. And it went, well, we're having a laugh, sort of pat ourselves back, going, we knew this was going to happen, right? But we're in the market. So we're not pressured to hurry up to try and capitalize on this period of growth because at a point in time when we could afford it, we invested in markets we knew would have long-term capital growth. Now, we're going to get the uplift of the city market. We don't need to enter it to get the uplift. We're getting the uplift right now because we invested in this market 8+ years ago. So if you can get in the market, my recommendation, and no doubt you would say the same thing, Scott, and you can afford it, enter the market. The best time to get into the property is when you can afford to get in the property because then if you invest well, you get the uplift irrespective of what happens. So
exactly.
Anyway, parting words. We'll go to another break. When we come back, another question. See you in a second.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Scott O'Neill, Director, Rethink Investing. Now, Scott, this is a pretty timely question because where are we now? Sort of middle-ish of February. And the question here is from Christy F. And I read it here. What do you think is going to happen when the government cancels JobKeeper? Is it better to wait until that happens or am I better off buying now? So thanks for note, Christy. I appreciate it. It's a really important question. No doubt you're getting a lot of this from your own guests anyway. For those who aren't familiar with it, not really cancelling JobKeeper, it's really JobKeeper coming to its end or its conclusion as the government said it would always do. When COVID-19 happened, the government went, how do we try and support the downturn in the economy and potential for job losses by keeping people employed? So they incentivize employers to hold on to their staff by underwriting their salary for a period of time. Now, the first period was 6 months up until the end of September. And to qualify for that, businesses needed to show in 1 month a downturn of 30% by memory, I think. And a lot of people were on JobKeeper. So what it means is get a big injection of cash into the employer's coffers so they continue to pay their staff's wages. That's really cool. Subsequent to that, JobKeeper 2.0 between October and December. To qualify, you had to show a downturn over a whole quarter, again, I think of 30% or so, in order to qualify for JobKeeper. And only 10% by memory of those businesses were on the first JobKeeper, qualified for the second JobKeeper at a reduced rate. Subsequent to that, there's this next phase of JobKeeper, which is between January and March 2021. So this is the period we're in right now. So after March 31st, there's no more JobKeeper, despite the fact of many different employment bodies lobbying the government for it. There's a case potentially that it might happen in certain segments like aviation, still open for debate and discussion. But what we know is that this tap is being turned off by the government at the end of March, so literally 6 or so weeks away. So the question here from Chrissy is, what's going to happen then? Is that going to change property markets at that point in time because there's going to be less people with, earning money, or people are going to be retrenched or laid off or whatever it is, right? There's a lot of dynamics around it. That said, there's not a lot of people on JobKeeper at the moment as a portion of all those that were at the start of the JobKeeper scenario. And our employment rate has really bounced back quite well. So what do you reckon? Do you wait or do you go?
So I think this is almost just one of those headlines that people are looking for a story in terms of property investment, because on the ground, and I'm fortunate because we do due diligence on businesses Like I'm talking dozens every week because we have to as part of our acquisitions of commercial property. If they're on JobKeeper, we don't buy them. We walk away from the deal. And there's massive, as a percentage, like we're really only running probably out of maybe less than 1 in 10 businesses are on JobKeeper, and it's not a huge portion of their profits. So it's not going to make much difference for most sectors. And there are some sectors that are struggling. Like it's the border closures, which are probably more noticeable effects, and that's tourism and some of those areas that, that rely on the fly in, fly out style arrangements. But in general, the unemployment rate's pretty healthy. I've got lots of clients that are recruiters. They're recruiting people, businesses are in a growth phase. Generally, property investors are not in vulnerable positions. So they're not on JobKeeper in general. I know I'm generalizing, but the people investing now are financially secure. So when JobKeeper ends, it makes no difference to them because they weren't on it in the first place. So I think it's just going to be the status quo. This impending deadline, whichever, like some people are using as a tactic to freak out with, is just going to go past, just like the interest-only cliff we used to hear about, or when APRA was going to, destroy the markets. There's always an impending doom with property, and I think this is just their best attempt at one at the moment, but it won't really make a difference to what we're seeing on the ground. Maybe from a rental point of view, some tenants will struggle. However, if you're smart about your investing, buy in areas where the vacancy rate's sub 1%. So even if, a small portion of those tenants start struggling, there's a huge demand for tenants anyway. So you can maneuver around the risk of the economy if you're smart about it. Same goes with commercial. Don't buy tourist-related stock. Well, it's not advice. It's just what, if you are going into that, you need to understand there's probably more risk than buying a doctor. They're not on JobKeeper. So, yeah, I think it's going to be a bit of a nothing, just personally.
Yeah, and everyone's heard about the September cliff and the December cliff and then the March cliff. There's always a cliff. But it goes to the point around asset selection. It's a really good, pertinent point that Scott just made in that, if you were heavy in apartment blocks in the inner city of Sydney or inner city of Melbourne, you'd probably be a little bit worried about this March cliff in that a lot of the people who potentially would be tenants of that may lose a job or may not have a job anymore because JobKeeper's turned off. So you got to get your asset selection right, planning for potentially all eventualities irrespective. No one saw COVID-19 happening, but our portfolio, the small property investment portfolio, hasn't really impacted at all. I can't think of anyone in our portfolio, and it's quite a large portfolio, which we lost them as a tenant because they lost JobKeeper or whatever. It's just, it's the exception rather than the norm. And if you think back to, and sort of chat beforehand around when COVID first hit, and I was pretty vocal about it, these idiot groups coming together about let's all lock arms together and refuse to pay our rent. And those evil landlords making money off us, poor old us, we've got no jobs. Even that didn't come to anything. So don't get caught up in the BS and stupidity sometimes peddled by the media, and that's not us. One more question, Scott. Sorry, a bit of soapbox there, but someone's got to do it.
Passionate.
Someone's got to do it. Final question here, and interesting. This is sort of a bit 101 type stuff, but we've got a lot of new to market investors, particularly in this market, so happy to cover this question. This is it's from Stephen. There you go. So two Steves. I don't know where Stephen's from, but Stephen says, hello. I'm a regular listener of the Smart Property Investment Podcast, and I was wondering if you could, or if you would be able to answer a question I have about refinancing. Sure thing. I have one investment property and I'm looking at getting it refinanced later in the year. Do the banks actually send someone physically to the property, or do they do it purely from recent sales in the area? The reason for the question is that there wouldn't be much point spending money to do a cosmetic renovation if no one is actually going to go to the address. Any help you could give be greatly appreciated. That's a good question, Stephen. The answer is it depends. Maybe you can talk our listeners through the valuation process, because there's different types of valuation depending on the purpose of it.
Yeah, so you've got desktop valuations and physical valuations. So depending on your bank's policy, depends on what style they go with. So if you're thinking about doing a cosmetic renovation, talk to your bank and ask them, are you going to get someone out there? Because I know personally, I've done a lot more desktop valuations in my own portfolio because, if you've got a number of properties, you probably just need to quickly cherry pick where there's equity. And, if you get 5 quick desktop vals and there's 50 grand there and 100 grand there, that's a lot easier than going through the full process. And it is done on comparable sales. Sometimes it's just pulled crudely off RP data and there's not much thought into it. For example, your renovations won't be included, but There are inputs in there, so you can choose medium quality or low quality, high spec, all that kind of stuff. So they can tinker around with it, but you just have to talk to your broker and go with the strategy that you think will be best suited for you. And if you think the renovation's going to, turn your $1 into $2, then go for it.
Yeah, it's a good point. And I'll telegraph the fact that probably in about 2 or 3 months' time, we're going to be having the discussion around why don't the banks value my property at what the property's worth in this market. So there's going to be this huge gap in between what properties are selling for and then what valuation a bank is willing to give it to you. So watch your space, but prepare for it. I think of our portfolio, and this is sort of purpose of strategy, a bit tactical before we chat beforehand, if you're looking to buy a property, manufacture equity in it, and get it refinanced as part of a strategy, which is cool. We've done that before. There is a gap between doing the work and getting the bank to realise that change, that fundamental change in a property, give it a different valuation. So we've got examples where we've spent 30 grand on a renovation. Then you try and refinance it sort of 3 months' time after you bought it, and the bank goes, nah, it's still the same. You go, I just spent 30 grand on it. Sometimes you might need to wait 6 months. Sometimes you might need to make 9 months. So you've got to factor all this stuff in before there is a tangible difference in how the bank views the property. So I'm not too close. So what's worked for us really well on that basis, and it sounds like this is where you're angling, is that you do a renovation, give it some time to breathe, as in, time after the actual original purchase. But a valuer, you can request it, can come to the house to check it out. Now, what I've done beforehand, and this was sort of counsel with our buyer's agent, was to meet the valuer on site and sit there with a photo book showing before and after photos and grab them and hit them with some propaganda, right? 'Cause most of the times, and for those of you who don't know, valuers need to do, if I'm a valuer, how many valuations would I be expected to do in a day? Heaps, right? Call it 6, 7, maybe more. So they're going to be on site for about 15 minutes. They're probably pissed off that they have to do it. They probably want to go home or go to the pub and have a schooner or something or other. It's just another day in the office for them. And property to them is completely commoditized. So they'll be looking at comparables and all this sort of stuff to try and frame a position. And before they even arrive at your investment property, they've probably worked out how much they're going to value it at, right? So be prepared for that. Might be important to you, not so important to them. They've just got a job to do. So you got to work pretty deftly to try and influence their perception around the property in order to get a better valuation for the purpose of refinancing. So arm yourself with some stuff, some photos, and sit down with them and go, look, this is what it was, this is what it is now. Look how much money I spent. It's really cool, great, this, that, and the other. So, use some tact and some charm to actually help persuade the valuer in a way in which they can see the value growth that you've put into the property. Sometimes I'll just tell you to nick off and leave them alone, but often they'll be quite receptive to it. So highly recommend that as a strategy if you're looking to do it for the purpose of refinancing. And I've had it, Scott. One example, you can go and check out on smartpropertyinvestment.com.au, property in the Central Coast where I did a full renovation on it, probably 3 months after I bought it. A valuer come out and gave me a really crap valuation, right? Left it about a month. I can't remember exactly the story. I left it about a month or so, tweaked a couple of things. Like when I'd done the valuation, it was a bit messy around. There's some paint on the floor and the fly screen was a bit ripped and shit, like 1%ers, right? Got another valuer out with another bank and they valued it sort of $50,000 or $60,000 more than what the original value was, literally a month after the first value went through. So beauty is in the eye of the beholder. So make sure you present your property as well as possible. You must see this all the time with vows.
Yeah, and a tip there is ask the local real estate agents their experience with valuers, because sometimes you can pick them. I know you can definitely do that with commercial. They've got a panel and you go, oh, well, don't touch that company because they're, going 10% under for no reason. And it does happen. So work with the ones that the agents like, because the agents want the values to go up it's all about getting a fair valuation. No value will ever go over market. Absolutely. And that's not what we're going for. It's to be at proper market value, not the arbitrary, let's just go 5% under because we're risk adverse and we're going to get sued and all that kind of valuer stuff. So there's valuers out there that will give you a fair evaluation and you just got to find them. And agents are normally your best source.
Yeah, one of them, and to add to that, as part of sort of putting together a pack for a valuer, I found that a couple of appraisals letters are really good as well, with a letterhead from the local agent as well saying, we view this property and we think it's worth between X and Y. And that's another way to help set fair market value. And that's what we're talking about here. It's not about manipulating and increasing value. It's about setting fair market value so you can realise the value in that as you grow your portfolio by using that equity to potentially purchase another property. I think we've gone pretty long, Scott. That's a good chat, mate. I think we've covered a lot of ground.
Yeah.
One-on-one stuff. It's got to do more of this. Got to do more of this. There you go.
Oh, you had a few good rants, mate.
I know. Need a rant. That's why I like these Q&As, because I get to have a bit of a go. But but it goes back to like you're a property professional. I'm just a property punter.
Oh.
So I can actually have a rant because I'm just a bloke with an opinion, whereas you actually provide good value and service to people who are looking to create wealth through property. So thanks for coming in and sharing your insights.
No problem, mate.
Really appreciate it. I'll see you on Inside Commercial Property soon. Remember to go and check that out. It's on the Smart Property Investment Podcast Network. It's also its own podcast as well. Go and check it out. And you can also access from your website, right? Rethink Investing?
Yeah, just Google Rethink Investing. You'll see us everywhere.
Yeah, and if anyone's got any sort of follow-up questions to what we spoke about today, you're happy to field them?
Of course.
Yeah? Okay. All right. So go to the website, rethinkinvesting.com.au. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.